Hello guys, Steven Duxer. Welcome to this new video. So today we're going to be covering what's the correlation between the overall market and the penny stocks, and also I want to go over the recent tickers that has been running and some of the patterns that I discovered. So by the way, we have a new course that's going to come out in February. Make sure to check out that course. It's called Trader's Edge. The pre-sale is going to end by the end of this month. Other than that, let's get into the video. So we have one CPI that came out, really pushed the market. Basically the market rallied about 5%. The reason I want to talk about the overall market is what I noticed is on every single spike there were different runners that's going up. So during this spike, I think was the GME AMC spike, a massive run up into a bounce short. Then during this spike we had BBBY, the meme stock. So into this spike, we will probably have something. One of the massive runners is going to come up. So opportunities will come during market rallies. And from my take on the overall market, the current conditions for the general market is, as the Fed, they're going to slowing down the rate hikes, but they're not, I would say, pausing or cutting the rate hikes. The financial conditions are still not as great compared to this massive QE from the Fed. So this rally is probably going to be temporary, and into this rally to the end of the year, we're going to have something to play with. Definitely tickers trading tons of volume. And what I noticed in this market is during each of those rallies, volumes are massively different compared to the market is going into a downturn. So the volume differences between the market going down compared to the market going up is drastically different. So make sure always use the data when the market is going up and use the data when the market is going down. For example, when the market started rallying in July to August, the volume is trading anywhere between 100 million to 200 million. So you have to use the same data into this spike as well. And of course, going to the opposite when the market is going into a downturn, then you want to use the same data that when the market is downtrending. This is one of the, I would say, patterns that I found out starting of the year. So the statistics that I found out specifically into this year, when the market is going to a downtrend, the volume is really low. Basically, it's not really tradable unless you see a very ideal bounce short with a massive volume comparison. But when the market is on the uptrend, the average dollar block is around 1.5 billion. So if the stock is around $10, you are looking at 150 million shares being traded. If the stock is around $15, then you're looking at 100 million shares going to be traded. So do the math, that's pretty easy. So what we had this week, we had DWAC. This is the trade that I placed a couple of days ago. So we had a gap up, fade all the way down, then formed its neutralized area around 20. This is where I shorted it into the next day as it gapped down. So you consider it as, I would say, not a great overextended gap down, but I waited until the consolidation to be formed. Shorted around, I think it was around 20, between 26 to 27. And I was going to write it down, but that weird spike in the afternoon made me cover. So I actually lost a very small amount. I think I covered around 20, anywhere between 27 and 28. So from my take on this trade is when the stock's neutralized area is really high, so typically a gap up short fades 75% from the top. So you can see DWAC faded about 75% when it spiked it to 30. So your max reward will be 21. Whenever you are shorting around 26, 27, your covering point has to be above the neutralized area. So you're looking at 23, 24 to cover, which into this trade, there is not much risk reward. So that's the mistakes I kind of made, but it was not much size. I noticed that the neutralized area is pretty high, so that actually destroys my risk reward, especially on a ticker that only went up 60%. So that was a very small loss, but going forward into DWAC, this respect again. So if this one can push through the $29 area, this DWAC might actually go up to 60 because once it breaks through the consolidations, then this consolidation area will become a massive support. It traded around 30 million shares around, I would say 27, 28. So you're looking at 1.5 billion support around $30 area. And once it breaks through the $30 area, you have to wait until the stock doubles from the support area to be able to consider it. It's a shortable stock. So be patient on DWAC. I think opportunities will be coming into the next few weeks. So for PIXY, massive resistance only around the $65, $68 area. I don't quite remember this one went up that high. Then we have a falling resistance around 39, around 8 million. So typically on a low volume ticker, when the stock only trades under 1 million shares throughout the day and also spiked over 50%, these type of tickers are very difficult to trade. You have to wait until the volume comes in, especially going into the resistance. And the starting point, it has to be the volume came in around later of the day, around let's say 19. This one has to go up at least 100% from this low volume zone, which is called neutralized area. So it has to go up to 38 to 40 before it's considered to be shortable. Whenever you see a ticker like PIXY and HKD, these type of tickers are very difficult to short into. So wait until the volume has to be at least, very least 5 million shares traded throughout the day before you place an order. Other than that, not much going on other than DWAC and PIXY. So hopefully we'll have more plays now coming into the next following weeks. That'll be end of this video. Thank you very much for watching. I will see you guys in the next one.